Hello, in this lecture we're going to talk about what a Section 1031 exchange is and how it can help a business in certain situations. We will be able to explain what a Section 1031 exchange is, describe an example of a simple 1031 exchange, and explain how a Section 1031 exchange can postpone taxes. So as always, you want to seek advice from a professional. We're going to go over the idea of a 1031 exchange, look at an example of it, but every transaction involving a like-kind exchange will be different, so you want to look into each transaction in and of itself. What could a Section 1031 exchange do for my business? The general idea of a 1031 exchange is that it postpones taxes under certain circumstances. So certain transactions that would qualify under a Section 1031 exchange would generally reduce the taxes for the current year and postpone them to a later year. That's the idea of it, and we'll talk a little bit as to why that would be using an example as we go. Does Section 1031 relate just to real estate transactions? If you look up 1031 exchange, you start to search on it, you're going to see a lot of stuff that's generally related to real estate. You're going to think that the exchange itself, that Section 1031 relates just to real estate. That's not generally the case. The reason you're going to see that a lot is because, of course, real estate is a big transaction. So people care a lot about real estate because of the dollar amount involved in it. And Section 1031 can be applied to certain areas of it. But the section itself isn't directly applied to real estate per se. And we'll take a look at what the code section says. And if we want to understand the Section 1031 exchange, it's best to take a look at a simple example and then build on that example. So whether we're talking about a complex real estate transaction or any type of application of the section to any type of property, it's good for us to get an understanding of the simple example so that we can then see the concept of it. We might be able to see some kind of justification as to why the section is there in the first place, and then add some levels and layers of complexity until we get to a more complex transaction as we go. So first, let's take a look at the code section. It's going to be a bit long, but it's worth just taking a look at the actual code section. So we have Section 1031A1. No gain or loss shall be recognized on the exchange of property held for productive use in a trade or business for investment if such property is exchanged solely for property of like kind. So we have this idea of like kind, which is to be held either in productive use in a trade or business or investment. So those are going to be some key terms that when you're thinking about a 1031 exchange, you want to see if it applies. One, what is like-kind property? So if you looking into an exchange and you don't know what that, you have to drill down on that idea of a like-kind property. And we also need to think of the idea that it's generally for a business type property or investment type property. So if we're talking about personal property, then it's not usually going to be something that will qualify. So those are the broad outlines of what we're looking at here. Now, there are some things that are specifically excluded from a 1031 exchange, and that includes a stock and a trade other than property held primarily for the sale, stock, bonds, and notes. So if you're doing, just stock trading, it's not like you can reduce the gain generally by exchanging one stock for another. Interest in partnerships is another big certificate of trust, beneficial interests. So let's take a look at an example of this. What is a simple example of an exchange? Again, the simple example will give us an idea of what the exchange is, why it's there, maybe some explanation of how the tax code was put together in terms of why this is applicable. Then we'll build some layers to that. So a simple kind of idea of an exchange would be that we just have a swap, meaning we're going to have one piece of equipment in this case, and we'll exchange it for another piece of equipment, and that's going to be it. So in this case, we're going to say that we have this green forklift. We went to the dealership, we saw a very similar blue forklift, and the two parties agreed to exchange the two forklifts and just have an exchange on it. No cash involved in this. Now you might be saying, of course, well, if you go to a dealership and you trade the forklift, it's very likely that there would be cash involved. We might have a trade-in, but we're usually going to trade up and then have some cash involved in the transaction. That's true, and we could take that into account at a later time, but let's take a look at the basic transaction where we're just trading one for the other. No cash involved. If we thought about that intuitively, you'd probably thinking, well, yeah, there's not going to be any gain or loss on that. All we're doing is giving one forklift for another forklift. Why would there be a tax transaction involved in any case? And the reason that often happens is because the book values may differ. So our book value, for example, may be lower than the actual value of the asset for tax purposes. That often happens because of accelerated depreciation methods. So the fact that we're able to depreciate in an accelerated method often means that we have assets on our books at a lower basis than their actual fair market value. So if we sell it or exchange it in this case, then it's very possible for us, our book value, not to match the fair market value. So let's take a look at that example of how that would happen in terms of first telling the story about the green forklift, the one that we're going to exchange for the blue forklift at a later time. How did the green forklift get on the books? What's going to be its book value before we come to this point where we exchange it for the blue one? For this, we're going to take a look at some transactions. If you're not familiar with debits and credits, that's okay. The story should still make sense here. We're going to buy the green forklift. So we buy it, we're going to say we buy it for $15,000. We would credit $15,000. That means cash would go down $15,000. We put the new forklift on the books for the $15,000. So this is the first forklift, the green one we bought sometime back in the past before the trade with the blue forklift. If we look at our books now, we would say, okay, now we've got the green forklift on the books here at $15,000. Note what did not happen. We did not record an expense down here. We didn't get any expense related to it. Even if we paid cash for it, we wouldn't have an expense even if we're on a cash basis. We did pay cash, but even if we were on a cash basis, we wouldn't have an expense related to the purchase of the forklift, even for taxes, because the tax code generally has us put it on as an asset and then depreciate it. Now, we may get an accelerated depreciation in year one, a 179 deduction or some type of accelerated depreciation, meaning we get to depreciate a large portion of it in year one, but the concept of this is that the forklift itself is not expensed at the time of purchase. We're going to record depreciation as we go. So let's take a look at what that looks like. So I'm not going to get into the type of depreciation we're going to record or the methods. Just going to say that we're going to depreciate it in some way, meaning we're going to take the value of this forklift. Although we only have one forklift and the forklift is still there, we're going to say that the value of it goes down over time. We call that depreciation. And so between the time period that we bought the green forklift and the time period that we're going to exchange it for the blue forklift, we're going to say that we're going to depreciate the value $5,000 by $5,000. So I'm not going to be specific on the time period, just going to say that we're going to record depreciation during that time period between those 2 points in time of $5,000. And that makes the depreciation expense go to $5,000. And it makes the accumulated depreciation go up in the credit direction to $5,000. So if we looked at the total books, what does that mean? It means that our book value now is 15 minus the 5. So the way we calculate book value is the cost minus the accumulated depreciation. Therefore, the book value now is $10,000. What happened on the income statement is that we got this expense lowering our income. Our income was $60,000. We lowered it to $55,000 at some point over that time period. That means we got a tax benefit because an expense is like a deduction. We got a tax benefit of $5,000 reducing our income. That means that whatever our tax rate is, 5,000 times our tax rate is basically the tax benefit we got. So we got a deduction of this $5,000 over this time period. Now let's take a look at the time period where we exchanged our green forklift for the new blue forklift. Let's assume the blue forklift has a sticker price of $15,000 at the time of the exchange, and we know that our green forklift has a book value of $10,000. Now, if the sticker price 15 is really the market value, if that's what going forklifts are selling for, then that's the fair market value. And that means that we assume the fair market value of both forklifts are $15,000. Why? Because the dealership is willing to accept our forklift for the going price of a normal forklift at that point. And if they're willing to do that, then the fair market value must be at the 15. Then why is it that our forklift is on the books for 10? Probably because of this accelerated depreciation. It's very likely that our books are lower for tax purposes than they should be in terms of the value of the equipment because of accelerated depreciation methods. So the depreciation methods for tax are not designed to basically be on there at a fair market value. They may be designed in some cases to have accelerated methods to stimulate the economy and whatnot. And so that could happen. Now, again, there would probably be cash involved in this transaction as well as the exchange. We're not going to deal with cash now. We're going to say that this exchange happened. And therefore, if we were going to do this in terms of a table, we would say, okay, the new forklift goes on the books for $15,000. That's the sticker price. That's what it's worth. The old forklift needs to come off the books. We bought it for $15,000, but it has accumulated depreciation of $5,000. Therefore, the book value of the old forklift is the $10,000. So if we take the $15,000 of the new forklift that we're getting minus the $10,000 of the old forklift, that means that we would have a gain of $5,000. So, and if you thought about it this way, you can think about it as, what if this was the fair market value of our forklift? Then we could sell it for $10,000 cash, and we'd have to buy the new forklift for $15,000. And so if they're giving us the new forklift for $15,000 and this one was actually worth $10,000, it would be like we've somehow got revenue of $5,000. How is that possible? Well, if you think of it intuitively, you'd think, well, that something's wrong there. And we're assuming that the thing that's wrong here is this $10,000 is understated due to accelerated depreciation, and this one is actually the correct value of both of them because that's the going price for forklifts at this time. That's kind of the assumption that we're making when we're doing this. So if we were to record this transaction in terms of debits and credits, same thing we just did in terms of debits and credits, and we put the new forklift on the books at 15, then we'd have to say, okay, blue forklift goes on the books, 15. That's our new forklift. The old forklift is going to come off the books. So it's on the books at 15. It needs to go off, so we're going to do the opposite thing to it. We're going to credit it, bringing it down to 0. We also have to get rid of the related depreciation, the accumulated depreciation. So that's a credit, so we're going to debit it to make it go down. That's now off the books. And then the debits don't equal the credits. In order for the debits on this side to equal the credits, we need a credit of $5,000. That, of course, is the gain. That would be over here. So if we pull over the other accounts, what's happening now then is we took the old one off the books and we put the new one on the books at the sticker price, 15, the fair market value, and we recognize this gain. So we had the 60,000 plus the 5 brings us to 65. That means there's going to be tax consequences if there was no 1031 exchange. This 5,000 now is some kind of income. We don't know exactly what type of income. We'll get another topic on that, but some type of income would generally have to be taxed if there was no 1031 exchange in order to kind of prevent this. That's how this happens. So what would we do to prevent that in terms of a 1031 exchange? Well, what's going to happen here is we're going to keep our book value here. And again, this isn't GAAP, so if you might be thinking, well, generally accepted accounting principles would have different depreciation methods than the tax code, and that's true. And but it's very possible also for companies that are not publicly traded to keep their books closer to maybe a tax basis. So I'm not saying this is GAAP, but this is going to be how we're assuming here that the books are being kept in terms of this company, and they're putting the new equipment on the books at that 15, and they want to record it at the fair market value of that 15. And in order to do that, they're recognizing this gain here on the sale. So for tax purposes, though, we're going to keep that, and we're going to say, okay, we're going to record another entry over here for the tax side of the transaction, basically eliminating this gain. So we're going to eliminate that gain, bringing it back down to 0, and the other side of the transaction then would be reducing the new forklift down to the 10,000. So now we're getting rid of, so if we look at that transaction now, here's where we were at for the books. We have the forklift on the books at the fair market value 15, and we recorded the gain. And then for taxes, what we're basically doing is we're saying, okay, we're gonna reduce the fair market value down to 10. 10 is going to be equal to the book value before the transaction. So the book value of the green one is now what we're going to put the blue one on the books for, and we're going to therefore eliminate the gain. Now there's pros and cons to this type of transaction. The good thing, of course, is that we're not going to recognize this 5,000 gain, and therefore we won't have the tax consequences at the time of the trade, at the time of the 1031 transaction. The bad thing is, for taxes, you always want to keep in mind that we would rather have the cost, or the basis we'll call it, to be higher than lower, because that generally means that if we sold this equipment, then we'd be able to recognize less of a gain or more of a loss. And if you think about it, if we hold this equipment for the life of the equipment, then we would record depreciation expense, a deduction, a good thing for taxes, over the life. And if it's only on there for 10,000, we're only going to get future deductions of 10,000 in one way or the other. Either we sell it or we depreciate it. As opposed to if it was on the books for 15,000, we would get the 15 over the life to a later time. It's really a timing difference that we're talking about in this case. That's what the 1031 exchange is doing. So later on we can talk about, okay, well, what if there was cash involved in this transaction? What if we traded this forklift for that forklift and there was cash involved? What if there was debt on this forklift and the dealership took on the debt related to the forklift? What if there's a timing difference between the two transactions? And finally, what if there's a third party that's basically acting as an agent to help facilitate the transaction? These are types of things that we can just build into the scenarios and get a better understanding of what is going on in a more complex kind of scenario.